Ever scrolled through social media and seen people talking about buying the dip or investing in Tesla? Ever wondered what exactly they're buying? Well, today we're diving into the world of stocks. We'll cover what they are, how they work, and why people get so excited about them. So, what exactly is a stock? Simply put, a stock represents ownership in a company. When you buy a stock, you literally own a tiny piece of that business. Pretty cool, right? Think of it this way. Imagine your favorite company is like a chocolate cake cut into thousands or even millions of slices. Each slice is what we call a share. When you buy a share, you're basically saying, "I'll take that slice of the company, please." For example, if a popular streaming service was divided into 10 shares total and you owned 5 of those shares, you'd actually own half of that company. In reality, big companies have millions of shares, so you'd likely own a much smaller percentage, but the concept is the same. You might be wondering, why would a company want to sell pieces of itself to random people? Good question. Companies sell stocks primarily to raise money. Creating and growing a business is expensive. They might need cash to build new factories, develop new products, expand to different countries, or even just pay their bills. Instead of borrowing from a bank and paying back with interest, they sell shares. The money they get doesn't need to be paid back. It's theirs to keep and use. Let me break this down with a story about Maya and her dream sneaker store. Maya wants to open Fresh Kicks, a store selling limited edition sneakers, but she needs $100,000 to get started. Unfortunately, she only has $50,000 saved up, still halfway there. Instead of a loan, Maya decides to divide her business into 10 equal shares. Each share is worth $10,000. Since she's putting in $50,000, she keeps 5 shares for herself. She still owns half the shop. Jordan, a sneakerhead, hears about Maya's plan and thinks, this could revolutionize the local sneaker scene. He buys 1 share for $10,000, which means he now owns 10% of Fresh Kicks. With money from Jordan and 4 other investors, Maya now has her $100,000 and can open her dream store. Fast forward 5 years, Fresh Kicks is absolutely crushing it. Maya has opened 3 more locations. The business that was once worth $100,000 is now valued at $300,000, triple the success. Remember Jordan? His 10% ownership is now worth $30,000. If he decides to sell, he'd make a $20,000 profit. Not bad, right? But investing isn't always a success story. What if Fresh Kicks struggled to compete? If the business value dropped to $80,000, Jordan's share would only be worth $8,000, meaning he lost $2,000. Ouch. This is exactly how stocks work in the real world, just on a much larger scale. Some companies also share their profits directly with shareholders through what's called dividends. It's like getting a slice of the profits just for being an owner. So, where do people go shopping for these company slices? They go to what's called a stock exchange. Think of a stock exchange like a marketplace. The most famous ones are the New York Stock Exchange and NASDAQ. These days, you don't have to physically go there. You can buy stocks right from your phone through investing apps. When a company gets big enough, it might go public by listing on an exchange. This allows anyone to easily buy and sell shares. Now, not all stocks are created equal. They typically come in 2 main flavors, common stock and preferred stock. Think of them like regular tickets and VIP tickets to the same concert. They both get you in, but with different perks. Common stock is what most people think of. When you own common stock, you get voting rights on important company decisions. Got 1 share? That's 1 vote. Got 1,000 shares? That's 1,000 votes to help elect the board of directors. The big advantage? Common stocks typically have the highest potential for growth. Your shares could skyrocket if the company does well. The downside is higher risk. If the company goes bankrupt, common stockholders are literally the last in line to get paid. Preferred stock is like the responsible older sibling of common stock. Usually you give up voting rights for other benefits. The big perk? Guaranteed dividends. Preferred stockholders get paid before common stockholders, and these payments are usually fixed and reliable. Think of preferred stock as a middle ground between stocks and bonds, less risky than common stock, but typically with less growth potential too. So, which is better? It depends. If you want maximum growth and don't mind risk, common stocks might be your jam. If you want more reliable income and less drama, preferred stocks might be more your style. Everyone's different. Why put your money into stocks instead of a safe bank account? Simple. Potential growth. Let's look at the numbers. While a bank might give you 1 to 2% interest annually, stocks have historically returned around 7 to 10% per year on average over the long term. Of course, that comes with more risk. The stock market can be a wild roller coaster ride with plenty of ups and downs. Some invest for the long term, hoping for growth over many years. Others try for quick profits by trading more frequently based on price changes. So there you have it, stocks in a nutshell. Remember, you're buying actual ownership in a real business, not just a random ticker. If you're thinking about investing, start with companies you understand and believe in. Knowledge is your best tool. And don't put all your money in one stock. That's like putting all your eggs in one basket. Diversify to stay safe. Thanks for watching. If you found this helpful, hit that like button and subscribe for more simple financial breakdowns. Drop a comment letting me know what financial topic you want me to explain next. See you soon.